Welcome to Sawyer Silver Valut. Right now, something is happening in Bitcoin that I have only seen a handful of times in the last 3 years. And if you are watching this, you need to pay attention. Not tomorrow, not next week, but in this exact moment. Because the moves being made behind the scenes right now could determine whether you enter the next leg of this bull run with confidence or get left behind watching from the sidelines. We are talking about a market that just minutes ago erupted with volatility so sharp, so sudden, that over $200 million in positions got wiped out in a single hour. Longs, shorts, it didn't matter. The market shook everyone. And underneath that chaos, something bigger is forming. Bitcoin just staged a powerful recovery after dipping deep into the mid-50,000 range earlier this week. But here's what the headlines aren't telling you. Let's start with the price. At the time of this recording, Bitcoin is trading at $64,800. That is up over 7% from the weekly low of $57,800 we saw just 3 days ago. But don't let that green candle fool you. The path here has been anything but smooth. Yesterday alone, Bitcoin crashed nearly $5,000 in under 90 minutes. No major news, no Fed announcement, no exchange hack. Just pure, relentless selling that triggered stop losses all the way down to 59,000. Then, as quickly as it dropped, it ripped higher. That kind of move, that violent two-sided action, is a signature of major players repositioning. And here's why you should care. Over the last 12 hours, on-chain data from CryptoQuant shows that wallets tied to known institutions moved over 23,000 Bitcoin. That's roughly $1.5 billion in value. Some of that went to exchanges. Some of it went to cold storage. But the pattern is unmistakable. Large entities are accumulating while retail traders panic. We saw this exact behavior in October of last year, right before Bitcoin ran from 28,000 to 49,000. And we saw it again in February, just before the breakout past 60,000. But today's news goes deeper. The US spot Bitcoin ETF complex just recorded its third largest inflow day since launch, with over $800 million entering the market in a single session. BlackRock's IBIT alone took in $420 million. That is not small money. That is pension funds, endowments, and asset managers who do not trade on Twitter hype. They trade on models, on risk premia, on long-term allocation shifts. And they are buying this dip aggressively. Meanwhile, the political landscape just threw fuel on the fire. Late last night, a senior SEC official hinted in a closed-door briefing that the agency may be reconsidering its stance on staking in Ethereum ETFs. But the real bombshell was a throwaway line about Bitcoin, a commodity, not a security, and therefore not subject to the same enforcement priorities. That sentence alone sent shockwaves through trading desks. Because if the SEC doubles down on that distinction, it opens the door for banks to custody Bitcoin directly without the current regulatory gray areas. We're talking about JP Morgan, Goldman, Bank of America. Each one could hold Bitcoin on behalf of clients by Q1 of next year. And that brings us to the whale movements that should terrify and excite you at the same time. Since this morning, 3 separate dormant Bitcoin addresses, wallets that hadn't moved since 2017, suddenly transferred over 14,000 Bitcoin to new wallets. In crypto, ancient coins moving is almost never random. It usually precedes a major price event. Sometimes it's a precursor to an OTC deal. Other times, it's an early signal that a large holder expects volatility and is repositioning into liquidity. But the timing here is everything. Those wallets moved exactly 2 hours before the Federal Reserve released its latest beige book, which showed weakening consumer spending but persistent inflation in services. In plain English, the Fed is boxed in. They can't cut rates too fast because inflation isn't fully tamed, but they can't keep rates high without breaking regional banks. That uncertainty is rocket fuel for Bitcoin. Because every time the traditional system looks fragile, the case for decentralized, non-sovereign money gets louder. So what are traders watching right now? Let's get technical. On the 4-hour chart, Bitcoin just reclaimed the 64,000 level, which was the neckline of a head and shoulders pattern that failed to complete. That is a bullish deviation, The relative strength index bounced from oversold 32 to 58 in less than 6 hours, showing aggressive buying pressure. The next major resistance sits at 67,800, the local high from last week. If Bitcoin breaks that with volume, the next logical target is the all-time high at 73,700. But if we fail to hold 64,000, then 62,000 is the first support. Below that, 59,500 is the line in the sand. Lose that and we could retest the mid-50,000s. But here's where the suspense peaks. The Chicago Mercantile Exchange, the CME, just recorded its largest Bitcoin futures gap in 6 months. The futures market closed Friday at 68,200, while spot Bitcoin was trading at 64,800. That's a $3,400 gap. Historically, CME gaps get filled about 90% of the time. But here's the twist. Gaps can fill immediately or they can sit for weeks. If sentiment turns ultra bullish, the gap acts as a magnet, pulling price upward. If fear returns, price could drop first to fill a lower gap from last week at 58,000. That tension, that knife-edge balance, is exactly where we are right now. Institutional options flow supports the bullish case. On Deribit, open interest for Bitcoin call options at strike prices 70,000 and 75,000, expiring this Friday, doubled overnight. Someone or some fund paid over $12 million in premiums for those calls. That is not a hedge. That is a speculative bet that Bitcoin will see a sharp move upward before the weekend. And with quarterly options expiry coming in 7 days, the so-called max pain level is currently at 62,000. Max pain is the price where most options expire worthless. Market makers often try to pin the price there. But when we see large asymmetric call buying like this, it suggests that one side is betting the pin won't hold. Now let's talk sentiment, because this is where beginners get hurt the most. The crypto fear and greed index dropped to 42 earlier this week, firmly in fear territory. But as of this recording, it has bounced to 54, neutral. That rapid shift from fear to neutral in less than 48 hours historically signals a bottoming process. The last 3 times we saw a similar fear to neutral recovery, Bitcoin averaged a 33% gain over the next 30 days. And those weren't bull market anomalies. Those were July 2021, January 2022, and October 2023. Each time, the crowd called for lower prices. Each time, the crowd was wrong. So what happens next? I'm watching 3 specific triggers. First, the US dollar index. DXY just broke above 106, its highest level since November. A strong dollar is usually headwind for Bitcoin, but if the dollar pulls back to 105, that relief could ignite the next leg up. Second, stablecoin inflows. Over the last 24 hours, the net issuance of USDT and USDC on exchanges jumped by $1.1 billion. That is dry powder. That is buyers waiting for the right moment. And third, the Bitcoin hash rate just hit a new all-time high, meaning miners are adding capacity despite lower prices. Historically, hash rate peaks lag price peaks by weeks or months. A new hash rate high at 64,000 suggests miners still expect much higher prices down the road. Before I wrap up, I want to leave you with one thought. The news cycle will try to distract you. Headlines will scream about a dead cat bounce or a bull trap. Social media will be flooded with screenshots of liquidations. But ignore the noise and watch the data. Institutions are accumulating. ETFs are seeing record inflows. Whale wallets are stirring. And the Federal Reserve has no easy path forward. That combination is the blueprint for the next major move in Bitcoin. The only question is whether you position yourself ahead of it or react after it happens. For more videos like this, subscribe to our channel Sawyer Silver Value News.